Hey everybody, in this video I'm gonna show you why and how you can beat the pros like Warren Buffett, Ray Dalio and Michael Burry in the stock market. With billions of dollars under management, they must gravitate toward the biggest stocks, the only ones they can buy in the multi-million-dollar quantities they need to fill their portfolios. Thus, many funds end up owning the same few overpriced giants. Investors tend to put more money into funds as the market rises. The managers use that new cash to buy more of the stocks they already own, driving prices to even more dangerous heights. If fund investors ask for their money back when the market drops, the managers may need to sell stocks to cash them out. Just as the funds are forced to buy stocks at inflated prices in a rising market, they become forced sellers as the stocks get cheap again. Many portfolio managers get bonuses for beating the market, so they obsessively measure their returns against benchmarks like the S&P 500 index. If a company gets added to an index, hundreds of funds compulsively buy it. If they don't, and that stock then does well, the managers look foolish. On the other hand, if they buy it and it does poorly, no one will blame them. Increasingly, fund managers are expected to specialize. Just as in medicine, the general practitioner has given way to the pediatric allergist and the geriatric otolaryngologist, fund managers must buy only small growth stocks or only mid-sized value stocks, or nothing but large blend stocks. If a company gets too big or too small or too cheap or an itty bit too expensive, the fund has to sell it even if the manager loves the stock. So there's no reason you can't do as well as the pros. What you cannot do is to beat the pros at their own game. The pros can't even win their own game. Why should you want to play it at all? If you follow their rules, you will lose, since you will end up as much a slave to market as the professionals are. Instead, recognize that investing intelligently is about controlling the controllable. You can't control whether the stocks or funds you buy will outperform the market today, next week, this month or this year. In the short run, your returns will always be hostage to market and his whims. But you can control your brokerage costs by trading rarely, patiently and cheaply, your ownership costs by refusing to buy mutual funds with excessive annual expenses, your expectations by using realism, not fantasy, to forecast your returns, your risk by deciding how much of your total assets to put at hazard in the stock market, by diversifying and by rebalancing your tax bills, by holding stocks for at least 1 year and, whenever possible, for at least 5 years to lower your capital gains liability and, most of all, your own behavior. The true investor is in that very position when he owns a listed common stock. You can take advantage of the daily market price or leave it alone, as dictated by your own judgment and inclination. Price fluctuations have only one significant meaning for the true investor. They provide you with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times, you will do better if you forget about the stock market and pays attention to your dividend returns and to the operating results of your companies. The most realistic distinction between the investor and the speculator is found in their attitude toward stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Click the button below to subscribe and turn on notifications so you don't miss more videos helping you have huge gains above the S&P 500 index in the stock market. See you in the next video. Take care.